Wall Street is turning bullish again. Sounds crazy? Let me break down why this might actually happen. Morgan Stanley just predicted the S&P 500 could jump another 12% by mid-2026 even after this massive rally we've already seen. Most people thought the market was overbought. But what if the bull run isn't done yet? Hey guys, I'm Alpha and you're watching Alpha Talks Finance. If you've been following the headlines, you know 2024 ended with stocks already at record highs. And yet one of the biggest banks on Wall Street is saying, don't discount this market out just yet. They're betting on something called a rolling recovery, and if you understand how it works, it could completely change how you position your portfolio over the next 2 years. This isn't the first time we've seen this play out. Back in the early 2000s, after the dot-com bubble burst, everyone thought tech was finished. Amazon fell over 90%. Cisco and Intel were cut in half. People walked away from the stock market entirely. But while the crowd was panicking, money quietly rotated into energy. And banks, Exxon doubled. The S&P Bank Index surged over 150%. And Warren Buffett, who was mocked at the time for ignoring tech, ended up sitting in the perfect seat, holding energy and financial stocks while everyone else was bleeding. Fast forward to today, Morgan Stanley says the same playbook might be repeating. The question is, will you catch this new rotation or miss it like most people did 20 years ago? Alright guys, so let's break this down. Morgan Stanley isn't just throwing numbers out there. When they say the S&P 500 could climb another 12% by mid-2026, it's not just blind optimism. It's based on something they call a rolling recovery. Now, what does that even mean? Think of the market like a relay race. Instead of every sector sprinting at the same time, one group hands the baton to the next. Tech might cool off for a while. But then financials pick up. When banks slow down, maybe energy or healthcare steps in. That way, the overall market keeps moving forward even if not every sector is winning at the same time. And we're already seeing signs of this. Look at last year. Tech carried the market, right? AI hype, Nvidia, Microsoft, Apple, they did the heavy lifting. But now, money is rotating. Utilities are getting love because of rising power demand from data centers. Banks are benefiting from higher interest rates. Energy companies are catching bids with global demand staying strong. This is the essence of a rolling recovery, different rooms in the market party at different times, but the whole house stays lit. Here's the thing, this idea of a rolling recovery isn't just theory. We've actually seen it happen before. When the dot-com bubble collapsed around 2000, tech stocks were absolutely crushed. Amazon dropped more than 90%. Cisco and Intel got cut in half. The headlines were screaming, tech is dead. And everyone thought the market was finished. This is my channel where I share insights on US stock investing, technical analysis, and tips on how to steadily grow your wealth. The content is simple and practical, perfect for beginners, but also helpful if you just want to learn a bit more about investing. My goal is to help you avoid mistakes, make smarter moves, and get closer to financial freedom together. And hey, don't forget to hit that subscribe button. But the money didn't just disappear, it rotated. Investors moved into energy and banks, and those sectors became the new leaders. From 2003 to 2007, energy stocks doubled, bank stocks ripped more than 150%. That's the power of rotation. One sector cools off, another picks up the baton, and the market keeps moving forward. But here's what really happened. The money didn't disappear, it rotated. Energy stocks quietly doubled between 2003 and 2007. Oil companies that everyone ignored became the stars of the next bull market. Banks rallied hard to the S&P Bank Index surged over 150%. And here's the kicker, Warren Buffett, who was criticized back then for staying away from flashy tech, ended up looking like a genius, while everyone else was bleeding in internet stocks. Buffett was sitting comfortably in Wells Fargo and energy names. This is the power of rotation. The crowd panics, but the smart money just follows where the capital flows, and that is who ends up making a killing. So fast forward to today, Morgan Stanley is basically saying, we might be looking at the same playbook all over again. Instead of money just chasing one sector like tech, they're expecting a rolling recovery. That means leadership rotates. First, industrials and energy pick up, then financials, then maybe healthcare, maybe utilities. One sector cools down, another takes the spotlight, and get this, they're predicting the S&P 500 could climb another 12% by mid-2026, even after this massive rally we've already had. That is not just a little bounce, that is trillions of dollars in market cap moving around. Think about it, in 2023 and 2024, AI stocks Nvidia, Microsoft, Apple, they completely dominated. But what happens if money starts flowing out of those names and into sectors like energy or banks? That could set up the next wave of winners, the way Exxon and Wells Fargo were in the 2000s. The big question is, are you gonna stay stuck in yesterday's trade, or are you gonna spot where the money's moving next? So let's break down what Morgan Stanley really means by this rolling recovery. Most people expect the market to either crash or keep going up in a straight line, but in reality, it almost never works like that. What they're saying is different parts of the economy are gone, not eight turns driving growth. One sector runs hot, then cools off, while another picks up the baton. It's like a relay race. The overall market keeps moving forward, but the leaders keep rotating. Now here's where it gets interesting. They're pointing to sectors like utilities and healthcare, the so-called defensives. Why? Because even in a high-rate environment, people still need electricity, still need medicine. These companies throw off steady cash flow, and that's exactly what investors want right now. Then there's energy. Remember how AI data centers are projected to boost US electricity demand by 20% over the next 5 years? Somebody has to power all that oil, natural gas, even renewables, they all stand to benefit. And don't forget the banks. Higher rates have actually widened profit margins for lenders back in the early 2000s. Warren Buffett loaded up on Wells Fargo while everyone else was chasing dot-coms. That one move alone made Berkshire billions when tech collapsed. So here's the play. Morgan Stanley thinks this rolling recovery, the winners could be in the boring sectors everyone's ignoring right now. Alright, let's zoom out for a second and talk about the bigger picture behind this call. Why is Morgan Stanley so confident? Well, look at the fundamentals. The US economy has been way more resilient than people expected. GDP growth hasn't collapsed, in fact. Consumer spending is still holding up. Job growth remains steady, and corporate profits in many sectors are beating expectations. On top of that, companies are sitting on record amounts of cash, and a lot of that is starting to flow back into buybacks and dividends. That creates a steady demand floor for stocks. And don't forget the Fed. Inflation is cooling off compared to the peak of 2022, and the market is already pricing in the possibility of rate cuts in 2025. If the Fed actually delivers, that means cheaper borrowing costs, stronger credit growth, and potentially another tailwind for equities. Combine that with ongoing government spending on infrastructure, clean energy, and AI-driven technology, and you've got multiple growth engines running at the same time. But, and this is a big but, none of this is guaranteed. There are real risks on the horizon. If inflation flares up again, maybe because oil prices spike or because supply chains get disrupted by geopolitical tensions, the Fed could be forced to keep interest rates higher for longer. That would pressure corporate margins and consumer demand. We've also got a US election coming up, and political uncertainty can inject serious volatility into markets. Add in global risks like tensions in Asia or Europe, and it is clear that this bull case isn't bulletproof. Here is the thing though, even if Morgan Stanley is right about the S&P 500 climbing another 12% by 2026, that doesn't mean it's a straight line up. History tells us there will be dips, maybe even corrections of 10-15 along the way. But for long-term investors, those pullbacks could actually be opportunities to rotate into the sectors that are just picking up the baton. So the key takeaway here isn't just stocks go up. It's about understanding where the leadership is shifting. If you can spot the rotation early, whether it's into utilities, banks, energy, or healthcare, that's where the real money is made. And if you ignore the shifts, you risk being stuck holding yesterday's winners while tomorrow's leaders pass you by. So what does this mean for you, the investor sitting at home? Here's the playbook. Rule number 1, don't dump all your tech. I know a lot of people are freaking out. Nvidia dropped, Apple pulled back, and everyone's screaming the AI bubble is bursting. But listen, AI isn't going away. The real question is, which companies are actually making money from it today? Stick with those. Rule number 2, add some defense. Boring names like utilities or healthcare may not sound sexy, but they pay you steady dividends and keep your portfolio alive when the market gets choppy. Remember, cash flow is king in a 5% interest rate world. Rule number 3, don't sleep on energy and banks. This is the exact same rotation that saved investors back in the 2000s. Exxon doubled, the S&P Bank Index surged more than 150%. History doesn't repeat, but it sure does rhyme. Rule number 4, rebalance. This is huge. A rolling recovery means leadership keeps changing. If you're not checking your portfolio every few months and adjusting, you're gonna get left behind. It's like surfing, you can't just catch one wave and think you're done. You gotta keep paddling, keep adjusting, if you want to ride it all the way in. Bottom line, Morgan Stanley thinks the S&P 500 has another 12% upside by mid-2026. But the money won't be made by sitting in the same trades that worked last year. It's about spotting the rotation early and positioning yourself before the crowd catches on. So here's the big question. Do you buy into Morgan Stanley's call that the S&P 500 still has another 12% upside by 2026? Thanks to this rolling recovery? Or do you think Wall Street's being way too optimistic and we're actually headed for another crash? I want to hear what you think. Drop your thoughts down in the comments. I'll be picking a few of the most interesting takes and breaking them down in my next video. And hey, if this helped you make sense of what's happening in the market, do me a favor. Hit that like button, smash subscribe, and turn on the bell so you don't miss the next upload. We're just getting started, and I want you riding this wave with me all the way to financial freedom. I'm Alpha. This is Alpha Talks Finance. Thanks for watching, and I'll see you in the next one.